Do you have a rental property, or do you know somebody that has a rental property? And what's the impact on your taxes? So let's take a look at Jill. So Jill purchased a property back in 2015, paid $450,000 for it, and with a rental property, it's divided up into the land, so what's the land worth, and what's the building worth. And we all know that most things or assets that depreciate or lose their value over time. And in this case, buildings lose their value at about 4%, from an accounting point of view. So what we do is we take the $450,000 times 4%, and we can deduct $18,000 from your rental income. So let's take a look and see how this works. Here's Jill's rental income. She's got property taxes, so she can deduct that from the income down to about $13,000. Then we've got the interest on her mortgage, which you can take off. And then we can deduct the depreciation, the 4%, or it's called the capital cost allowance, CCA for short. Now you notice it's not the $18,000 because we can only reduce the rent down to 0. We can't have a negative rent. But what we're seeing here is she doesn't have to report any of her rental income on her tax return because it's all been deducted. So let's take a look and see what happens if she didn't use the CAA or deduct the CAA. So we can see here there's no capital cost allowance for the deduction. So Jill has to report on her tax return that she's earned about $9,432 in rental income. And when we compare the two, so claiming the capital cost allowance and not claiming the capital cost allowance, we can see that when we look at Jill's cash flow, there's about a $3,000 difference between claiming it and not claiming it. So everything looks pretty good. But let's take a look and see what happens when she decides to sell the rental property 20 years down the road. So we can see here, 2037, the property's been sold, and there's something called recapture. Guess what? The building didn't actually depreciate in value, so you have to pay back what you deducted in the CCA. And that is actually included as rent in that year. So this is what Jill would have to claim on her tax return from the rent. But let's go and take a look at her actual tax return. And here's her return in 2037, and we can see the rental income there, $202,000. So that's just paying back the capital cost allowance that we deducted from income. And then, of course, there's capital gains tax that she has to pay. Let's just compare that to the tax return when she didn't claim the capital cost allowance. And you can see here, there's no rental income, but there's still the capital gains to pay on the sale of the property. And here's the side-by-side comparison. So you can see there's a difference of about $110,000 in tax owing when the property is sold. So that should give you a good idea on how the rental income works from a tax perspective. So now the next thing really is to figure out, okay, looking at everything else you've got going on and the things you're doing, what's the best thing for you to do? Should you deduct the capital cost allowance or should you not?